Chapter 23 adds flexible budgeting to our list of topics related to the budgeting area. So remember, in our prior chapter we talked about the master budget and all of the supporting documents that are needed to prepare the master budget. So in this chapter, we're going to look at how the flexible budget and the performance report can help us to make better management decisions about our organization. We'll look at the differences between the budget and our actual numbers to identify variances, and we will use standard costing to understand how those variances occurred. We'll compute the difference between our actual production and our budget in the areas of direct material, direct labor, and manufacturing overhead. We'll also talk about the different areas, divisions, or people who might have the responsibility for those variances in material prices or labor prices or overhead. And we'll talk about how we record the journal entries and the cost that are moving through a standard cost system. So let's begin with learning objective 1 in preparing a flexible budget and using a performance report to analyze our budget and make decisions about how our organization can possibly be more efficient. So if you'll remember from our master budget, we were talking about planning, and this chapter is going to focus more on the controlling step that you see and helping managers identify things that they can do to control their cost. So this was the illustration that we had before in recognizing that a company needs a strategy. What is their overall strategy or business objective? And then we prepared that master budget of anticipated revenues and expenses to identify what we thought we were going to do in our manufacturing process. We begin to act on those and produce our products. And then we get to the area related to control, which is really what we're going to look at in this chapter, a performance report. How do the budgeted numbers that we prepared in this master budget actually compare to what we were doing in the manufacturing setting? And we'll use a flexible budget to do that. The static budget, which is what we prepare in the master budget, is prepared for, let me grab a pen here, only one level of sales volume. So the static budget is prepared estimating the number of units that we think we're going to sell, let's say 50,000 smart tablets. And then the variance that occurs is the difference between the costs that we actually incurred and those that we budgeted or that we thought we were going to incur. And so that static budget variance, once again, is driven by a change in our sales volume. Okay, so variances can be favorable or unfavorable, and we obviously like favorable variances better. If we have budgeted revenues and we exceed those, our actual revenue exceeds what we budgeted, that's favorable. That's a good thing. Or if our actual expenses are less than what we budgeted, that's a good thing. Those are favorable variances. Unfavorable or right the opposite. If my revenues are less than what I thought they should be, that's unfavorable. And if my actual expenses are more than what I thought they should be, that's unfavorable. However, with that static budget, if we compare the actual production of 55,000 units with our budget of 50,000 units, then we should have additional revenues, and we should have additional expenses. Okay, so we have to take into consideration what is causing our variances. On the other hand, if I budgeted for 50,000 smart tabs and I only manufactured and sold 45, then my revenue should be less than what we budgeted. So we have to be careful with the static budget. because we're not comparing apples to apples when we're comparing budget to actual. Very rarely will we ever manufacture and sell exactly what we predicted. And so we want to be careful that we don't compare actual revenue and cost of 55,000 units with a budget of 50,000 units. Hence, we need what's called a flexible budget. And we see in this illustration, if we've estimated that we would sell 48,000 units. I know this that we've anticipated 750 per unit for sales. And if you'll notice in the cost below here, go back to our variable and fixed cost discussion. The variable costs are the same per unit, regardless of whether I manufacture 48,000, 50,000, or 52,000 units. Okay, so if I manufacture 48 and sell 48,000 units and materials cost me $175 a unit, my materials cost are $84,000. But if I manufacture and sell 50,000 units, we would expect, okay, that we are going to exceed that $84,000 because for 50,000 units I needed more materials. So yes, the cost has increased. That's an unfavorable variance if we're looking at a static budget, but it's something that we should have anticipated if we are going to produce more units. So that's why we need the flexible budget. And if you'll notice, these are our variable costs, okay, but our fixed costs are at the bottom, and on our fixed costs, they stay the same regardless of whether we manufacture 48,000, 50,000, or 52,000 units. So I use a flexible budget to determine what would my operating income be here if I manufactured 48,000 units. How much would it increase if I manufactured and sold 50? How much would it increase if I manufactured and sold 52,000? So we can see that our operating budget, our operating income in our budget is going to change depending on the number of units that we actually manufacture and sell. And so the flexible budget gives us the ability to look at our revenues and our expenses at these various levels of sales volume. Okay, within a relevant range, because once I get to 100,000 units, that may require an additional shift, a new supervisor, more property, plant, and equipment. At that point, we're outside of our relevant range. But the flexible budget helps us to analyze what our revenue and expense should be at different levels within a relevant range. And we're separating variable cost from fixed cost because we need some per unit cost. So the flex is what's important to us here. We can change our budget depending on our actual output. So we need a couple of things to do it. As you saw before, we need selling price per unit. This would be determined in your master budget. We need the variable cost per unit. Once again, this would be established in your static budget, and it changes the more the total will change the more or less we produce, but the cost per unit stay the same. We need our total fixed cost, and we need to know what our volume level is going to be. And with this information, we can prepare the flexible budget that you see here that is just like the one we saw before. As the units that I sell increase from 48,000 to 50,000, and then they increase from 50 to 52, then I can estimate the increased variable cost, compare them to my fixed costs, which are the same, and it helps me to analyze my new operating income. So in this particular situation, let's see if we can, well, let's hold off for one more slide here. When we have a variance, when we have a difference in our sales revenue, a difference in our cost, then we want to know not just that a difference occurred, but why it occurred. And so the flexible budget variance helps us to do that by comparing what were our actual results. Okay, so what cost did we actually incur for 50,000 units, and let's compare that to what a budget should have been for 50,000 units. That's how a flexible budget works. Okay, the sales volume variance, on the other hand, is the difference between what we should have spent on those 50,000 units compared to what we actually predicted in our static budget. Okay, and so we're going to focus primarily up here on the flexible budget and the remainder of this chapter. But the two of those things combined, okay, our flexible budget variance and our sales volume variance together generate a static budget variance. But this is what we can use to make decisions, to control out of control cost, or unexpected variances. And so if we take a look at a flexible budget performance report, we can see, okay, this flexible budget variance that we just discussed. Once again, what we want to know, and we can kind of start from the back side of this, our static budget was for 50,000 units. So in our master plan, this is what we estimated we would sell, 50,000 units. But what happened when we put the plan into action was we manufactured and sold 52,000 units. So once again, realize that a comparison of the cost of 52,000 units and the cost of 50,000 are going to be different. So we want to compare in a flexible budget that we see here, what if I actually manufactured 52,000 units. Okay, those are the costs for 52,000 units that you see here. Okay, what should my budget have been for 52,000 units so that I can compare estimates for 52,000, which we see in this column, with what I actually spent on 52,000, and the difference is my flexible budget. Now, the sales volume variance, on the other hand, simply takes a comparison. This is what I should have spent on 52,000 units, and this is the budget that I actually prepared, and here's my difference. It's only based on volume, and so we can't really use that to make wise business decisions. So what we want to focus on is here. How can I determine what caused the $680 unfavorable variance? And we would work our way down. So the revenue that we actually generated for 52,000 units is less than what I thought I would have generated for 52,000. Why is that? Did we have returns and allowances? Did I have to decrease my sales price? What happened? So we don't want to just know that there's an unfavorable variance, but why? We can tell that in my budget, I should have spent $91,000 on materials, but I actually spent $104,000. That's unfavorable. Why did I spend more on my materials than I thought? Okay, and one last, in administrative expenses, I thought I would spend $22,500. I actually spent $25,600, and so once again, why did I spend more than I thought on those selling and administrative expenses? And this is where we will go in our next objective, in learning objective 2, about how to utilize a standard cost system to understand and analyze those particular variances.